The exchange is closed, the data feed is dead, and silver is locked in ice at 79.25 after a violent 10% tear in a single trading day. That wasn't just a rally, that was a warning shot aimed directly at the solvency of the system. While you're enjoying your weekend, phones are melting down in risk management departments across the globe. Why? Because a 10% vertical move in silver isn't just volatility, it's an extinction event for leveraged portfolios. The market is closed, but the danger hasn't passed. It is simply pooled together, waiting for the Sunday open. Welcome back. You're watching the channel that decodes the signal from the noise. No fluff, just the mechanics of the machine. Today, we are dissecting what this silence really means, what the banks are terrified of, and why the price action at the Sunday open will tell us if the financial plumbing is about to burst. Let's strip this down to the core mechanic. Leverage. Wall Street despises using its own money. Silver futures aren't bought with cash. They are bought with thin slices of equity and massive piles of debt. When you are leveraged 20 to 1, a 5% move against you wipes you out. At 50 to 1, a mere 2% move sends you to the graveyard. So, what happens when the asset rips 10% higher? It doesn't just hurt, it obliterates. This triggers a cascade. Margin calls go out. Collateral is demanded. Risk models, calibrated for a peaceful world, suddenly flash red because silver just declared war on stability. This is why emergency meetings happen on weekends. It's not about the price, it's about the trapped money. In this game, a trapped trader bankrupts a broker, and a bankrupt broker threatens the clearinghouse. That is the holy grail of financial fear. The clearinghouse. We are told the central clearing system is the ultimate shield, guaranteeing every trade settles. But that guarantee is backed by a default fund, a bucket of cash meant to put out a campfire, not a forest fire. When short exposure runs into the billions, a gap up isn't a trading anomaly. It is an invoice that the insurance pool cannot pay. This is when the professionals panic. Retail traders wait to see what happens. Professionals run for the exits immediately. If the big players suspect the counterparty can't pay, liquidity evaporates. They pull their bids, they stop lending. The gears grind to a halt. You ask, why panic over silver? It's a tiny market. That is exactly why. It is small enough to be manipulated, but tight enough to snap back and break the fingers of anyone holding it down. Here is the uncomfortable truth. Most entities shorting silver aren't evil villains. They are boring institutions. They are hedging inventory, running carry trades, or selling volatility. It's free money until the chart goes vertical. Then, the boring trade becomes a suicide pact. If a massive industrial giant or a commodity trading house gets liquidated, it's not just a closed account. It's a systemic domino falling over. That brings us to the weekend ritual. Friday, the explosion. Saturday, the panic meetings. Sunday, the gap. Monday, the rule changes. So, what weapons do they have left? When the system is cornered, it opens the same dirty playbook every time. First, margin hikes. They call it prudence. It's actually a purge. By raising the cost to hold a contract, they force leveraged longs to sell. It shakes out the tourists, but it doesn't stop the whales who are buying with cash. Second, position limits. They tell you you can't own more than X amount. All this does is force big money to route their buy orders through opaque, private channels. Third, trading halts. They pause the game to cool the temperature. Usually, this just creates panic. When you lock the doors, people don't calm down. They smash the windows to get out. And finally, the nuclear option. Liquidation only. You can sell, but you cannot buy. It destroys the reputation of the exchange, but it forces the paper price down. However, it sends a fatal signal. We cannot source the metal. There is a darker clause you need to know about. Cash settlement. This is the divorce of paper from reality. If they can't deliver the silver, they force you to take fiat currency instead. This is the moment the paper market becomes irrelevant. You cannot build a solar panel with a dollar bill. They will fight this on two fronts, the mechanical front and the narrative front. Expect the headlines. Regulators watching irregular activity. Bubble warnings. Liquidity is fine. It is a psychological operation. If they scare you into selling, you provide the liquidity they desperately need. Ask yourself, if this price move is nothing, why the emergency meetings? The panic is the proof. Now look at the macro picture. Silver is collateral. When a fund gets a margin call on silver, they don't sell their silver losses. They sell their winners. They dump stocks, they dump crypto, they dump bonds. They need dollars immediately. A squeeze in silver acts like a vacuum, sucking liquidity out of the entire global system. If bonds start to wobble while margin requirements are spiking, the system is getting crushed from both ends. Collateral value is falling while liability is rising. This is how a trading problem becomes a banking crisis. This is why you hear rumors of central bank intervention, not because they love silver, but because they need the settlement system to open on Monday morning. But here's the irony. Injecting liquidity to save the system creates more currency, which ultimately drives hard assets even higher. The cure is also the poison. Let's move to the arena they can't control, the physical market. Bullion dealers do not care about the COMEX rulebook. If they can't restock, they raise premiums. Watch the spread. If the screen price drops but the physical premium skyrockets, the drop is a lie. If the screen price rips and premiums expand further, there is no metal left. This is where the Sunday open becomes dangerous for the shorts. While New York sleeps, the world is awake. If physical silver trading in Shanghai or London is higher than the frozen New York price, arbitrage bots will turn on. They will buy the cheap paper silver to capture the spread, hitting the market with a wave of buy orders the second it opens. Intervention can backfire. If they artificially cap the paper price, they just incentivize every buyer on Earth to drain the Western vaults and ship the metal east. Capping the price doesn't stop the run, it accelerates the bankruptcy of the inventory. Producers are watching too. Why sell today if the price is repricing? Supply gets held back, contracts get delayed. When inventory is thin, even a small hesitation in supply creates a massive shock. So Sunday night is not just a data point, it is a stress test. Scenario A, silver gaps up through $80. This means the weekend containment failed. Algorithms chase the momentum. The media is forced to cover it. The squeeze expands. Scenario B, silver gaps down. Do not assume the squeeze is over. Check the volume. If it drops on low volume and is immediately bought up, that is a bear trap. The levels to watch are psychological. $80 is the breach. $90 is the acceleration. $100 is the fortress. Triple digits change human psychology. It brings in the public. And when the herd arrives, they arrive with force. Remember, in the short term, higher prices create more demand, not less. Panic buying is a powerful drug. Companies stop waiting for a dip and start hoarding to secure supply. The market goes vertical. We also have to talk about the shadow layer. There are funds and strategies out there that are invisible until they blow up. Market-neutral strategies that suddenly aren't neutral. When these explode, they become forced buyers. They don't care about the price. They buy because the contract says they must. This mechanical buying is what drives a squeeze into the stratosphere. They can print paper. They can print headlines. They cannot print ounces. Practical action plan. Do not trade the noise. If you're trying to scalp this, you will get wrecked by volatility. Audit your holdings. If you hold physical, you are safe. If you hold paper, read the fine print. Look for force majeure or cash settlement clauses. In a crisis, those clauses will be used against you. Watch the real price. The screen is a suggestion. The price you pay to acquire physical metal is reality. Hold the line. The market will try to shake you out with violent swings. Up hard, down hard. This is designed to induce motion sickness. Ignore it. Stop counting in dollars. Start counting in ounces. Finally, the geopolitical wildcard. When silver becomes a strategic asset, governments stop being referees and start being players. Export bans, windfall taxes, national security supply chain initiatives. A single announcement from a major producer can delete future supply from the market instantly. The shorts are not just betting against a price, they are betting against geopolitical chaos. The bottom line? The world will be watching the ticker at the open. The smart money will be watching the physical premium. If the screen says $79, but you can't buy real metal for less than $90, the dam is breaking. If you see a gap up, don't assume it's hype. It's the market correcting a pricing error. If they try to cap it, they are just moving the price discovery to a venue they don't control. So, here's the question for Sunday night. Does the system let the market clear, or do they break the rules to save the shorts? Either way, the long-term trend is bullish, but the path there is about to get violent. I want your ground intel. If you tried to buy metal today, what did you see? Delays? Empty shelves? Let me know in the comments. Your report is worth more than the news. Silver is frozen at $79. The quiet is deceptive. It's not peace. It's the deep breath before the plunge. If we open above $80, containment has failed. If we smash down but premiums hold, the paper market is dead. This weekend is the checkpoint. If you want to be the first to know which rules they change on Monday, hit subscribe. We'll be here when the tape starts moving.